Hey there, everyone. It's Joe from Ainslie's Gold Silver Standard Insights, brought to you by goldsilverstandard.com and ainslieBullion.com.au. Today's topic is, what does a currency crisis mean for gold? Now, I'll put a link below to the specific news posted on the Ainslie website for you to follow along to. And joining us today, as always, we have Chris Tipper from Gold Silver Standard to break down that news. And joining Chris today is Josh Lang. Now, Josh is one of the Ainslie team members, and he also happened to have written today's news. So welcome back to the show, Josh and Chris. Over to you.
Thanks, Joe. Well, since our last Insights video, we've had the rate decision out of the US. They went with the 0.75%, exactly as predicted. And just as we discussed on here, even though we knew exactly what to expect, there were significant moves in the markets regardless. The US dollar broke out into new all-time high territory as a result. And as I mentioned at the time, when we were predicting that was likely to occur, it now has no additional technical resistance standing in its way as the momentum of that wrecking ball comes crashing back into the markets once more. The move is certainly extended in US dollar strength and is starting to get the attention of central banks and policymakers around the world, as no country is immune from the pain when we're dealing with the global reserve currency. The problem we have is the Fed has been crystal clear that it will not stop raising rates until inflation is under control, but the strong US dollar is fueling inflation everywhere else in the world, as they effectively export their domestic inflation onto others. So they've backed themselves into a global inflation loop where they're now contributing to the thing they were trying to eliminate. So the question becomes, what breaks first? Does the Fed give in and pivot, or does the rest of the world attempt to abandon the dollar to some degree? I've been hearing strong arguments for both opinions, and we saw the Japanese intervene in their currency market last week for the first time in decades, since way back in 1998, as a hint of what might be coming for other governments as they all scramble to shield themselves. Typically, intervention isn't in isolation. If they do it in isolation, it doesn't work. And we've seen this happen already with the yen wipe out most of those gains since they did intervene already. So we need to be prepared for a much more substantial and globally coordinated response coming. Josh joins me today, and he has been researching this unfolding currency crisis for the news, particularly in terms of where gold can play a role in protecting your portfolio when there is seemingly nowhere else to hide right now. So thanks for your work on that, Josh. And I have a few questions I'd love for you to further break down for us.
Sure, mate.
So firstly, in terms of the Fed rate hike last week, can you give us a quick recap of what they've done, how the market reacted, and what we can expect next from that angle?
Yeah, sure. So like you said, Chris, the Fed raised rates by 75 basis points again, the third time in a row. That seemed to trigger all the events that happened on Friday, which led into this morning. So the Fed, they just remain gung-ho on bringing that inflation number back to their target 2%, and they're just not pulling any punches in getting there. So the Fed was able to justify that decision of that third consecutive rate hike because that latest CPI print came out worse than what everyone expected. This paired with interest rate hikes caused equity markets to tumble, as well as other currencies, which we'll get into. So we saw the S&P, ASX, they're hunting for new yearly lows as we speak. I mean, we're 1.5% away from a brand new low in the S&P, which is terrifying. Yep. Once, or if it does break, we have zero idea of where that bottom will be. So, you know, a few experts have suggested that we could see it even fall as far as 3,000, which I think is around a 35% drop from the top. And it takes us back to about, you know, pre-COVID levels before they started just printing like crazy. So the Fed could then consider everything reset and begin, you know, lowering rates steadily. But the problem with this is that by the time we get to that point, we could be very deep into a recession. So, you know, we'd be seeing high unemployment, an imploding housing market, wages well below inflation. And, you know, it's a multi-year process to get out of that. So it's just damage across the board.
Yeah, and it does take a long time to undo that damage. We also can't ignore government bonds in this discussion because they're the ultimate driver of market liquidity. So there's been some concern that I've been hearing about the bond markets becoming very broken and mispriced here, with the potential for a liquidity crunch rapidly approaching. And those liquidity crunches can typically be what send us into full-on crisis. So how are you interpreting what you see there in the bond markets?
Well, yeah, we currently have a pretty extreme inversion of the yield curve. So the 10-year yield is lower than the 2-year yield, even though it would usually be higher to account for, you know, extra uncertainty that comes with, you know, looking further into the future. So when that curve does invert, it's usually regarded as a recession indicator. So if we're not in it already, as everyone says, then it's coming. But I'd very much argue we're probably already there. So that's pretty significant that the yield curve has actually inverted to the extent of more than 50 basis points. So that's the first time in 40 years. So if you're reading into what the bond market, if you're reading what the bond market's telling us, it's, that the market thinks the Fed is about to overdo it, just raising rates way too quickly for the short run. And it's just, that it's just not going to work.
Sure. And I mentioned, well, we're seeing the carnage from that already starting to happen. And I mentioned in the introduction about the significant move made by the Bank of Japan last week in attempting to support their currency, and how arguably that's ineffective because we've seen it really bounce straight back. So do you have any additional background information on what's happening there with the Japanese yen situation?
Well, yeah. While the monetary decisions in the States and Japan were both what was expected, the US interest rates actually rose, so that caused the yen to weaken even more. And the result of that has the Bank of Japan, they've maintained, ultra low interest rates, and they're with their policy guidance as it seeks to reassure that markets will be, swim into that global tide of central banks just tightening. They're doing that to combat, soaring inflation. But this strategy has caused the yen to get demolished. It's almost down 20% this year. And even after the Fed announced its latest hike last week, the BOJ reaffirmed that it's not going to do anything at all, which actually prompted the ministry to take its first intervention to prop up the yen in 24 years, which that's why the yen didn't fall as far as other currencies on Friday. I haven't checked this morning, but I imagine it's probably similar. But across the globe, we're seeing currency fall. Yeah,
it didn't fall, but it it did have a little spike, but it was really nothing. It was a couple of days worth of movement. It really didn't make a big difference. So like the yen, the pound has been making some extreme moves as well. So is that being driven by the same pressures? And does it look like any relief's coming there for the British pound?
Yeah, well, the pound has been an interesting one to watch. It's hit a new 37-year low after announcements of tax cuts and spending measures in the latest mini budget they had. So that announcement caused the pound to fall about 3.75% on Friday. We're talking a top 5 economy, and their currency is more volatile than Bitcoin at the time. It's ridiculous. And since making my notes this morning and writing the news, it's also fallen another 3 to 4%. So the pound has now sunk by more than the value of those tax cuts. Just think about that. It's just not worked.
Yeah.
So this morning we noted that it'd fallen 19% year to date. That's actually not up to now 23%, which is worse than most third world countries. This
isn't a third world country. This is Britain.
Yeah. So in light of that, the IFS has actually come out stating that the market's reaction was worrying, which is interesting, as the government's strategy relied on investor sentiment and, them willing to lend more money to the UK. So the plan seems to be that investors would borrow large sums of money, which, at expensive rates. Why would they? They'd be putting government debt on an unsustainable rising path and hoping that they get better growth. It's a plan. I'm not sure the market thinks it's a good one, which kind of ruins the entire point because it's all about consumer confidence. So it just hasn't worked, and we've seen it in the pound just getting destroyed. Anyway, analysts are suggesting that UK interest rates are probably going to hit 5.2% in August 2023, with expectations that there's probably going to be a 1% raise in the Bank of England's next meeting in November. So pretty rough in the UK at the moment. The pound looks pretty bad.
Yeah, it's not a good picture across the board. I would argue a lot of that's unsustainable. I don't think we even get, when we hear predictions about where we'll be in August 2023, I think, I'm curious to see where we end up in November 2022 yet. So big calls there. But where does gold fit in all of this? Because obviously we haven't seen really gold take off, but we also haven't seen it substantially fall. So you would see in this level of really unprecedented uncertainty that gold should have a role to play. How do you look at that?
It's topical at the moment because it actually really does depend on what currency you're measuring it in. So
Sure.
actually, interestingly, this morning, priced in the pound, gold just hit an all-time high.
Yes.
But here in Australia, we've seen gold do what it's kind of supposed to do, which is nothing.
Yeah.
So it's tracked sideways for months now after a volatile start to the year, but the last few months has just been nothing. But then you also look at it measured in US dollar, it's actually declined. Nowhere near as much as the dollar's gone up, which is a good thing. But as we said in today's news, it's a matter of when that tide turns and when the dollar starts to decrease. So you can imagine gold will be a great benefactor of when that does happen.
Mm-hmm.
So equities may still be in a state of shock. Take a while to get out of there, but they'll be stuck in decreased earnings, which just make it harder for them to grow out of there. But there's no fundamental factors like that really weighing down gold.
Oh, that's great. Well, thanks so much for your insight and analysis with us here today, Josh. We'll certainly continue to keep a close eye on the US dollar and any hint that there may be some relief ahead. But like you said, for now, we probably just need to keep protecting ourselves as best we can, because really we can't see an end in sight just yet.
I can imagine there's a lot of people in the UK right now looking for gold.
Yeah, for sure. All right. Thanks again, Josh.
All good. Thank you.
Thanks so much for being on the show, Josh. Always good to have you. And Chris, I'll see you on the next one. And for the audience, if you want to continue the conversation with Chris and Josh, head over to the Discord channel. That's discord.gg/gold. They'll be on there for about 1 or 2 hours after the upload of this video. So it's the perfect chance to be with like-minded individuals, ask your questions, and also give us some feedback. We would love to hear from you. I, of course, always want you to subscribe to the YouTube channel, youtube.com/Ainslie Bullion, for the wide range of informational videos 5 days a week. And lastly, do check out goldsilverstandard.com. That's bringing gold and silver into the digital world. Like, share, and subscribe. Balance your wealth in an unbalanced world. Take care, and we'll see you soon.